Good morning, everyone. Welcome back to another episode of Xenith Trading Recaps and Analysis. Today's video is actually going to be a continuation of last week's video in which I summarized my entire bearish thesis that was built over the past 2 to 3 weeks, almost going on a month now. I'm also going to be discussing a thesis that I've been marinating in for the past couple of years, in which I've spent more time diving into this year. I'll be with you in just a second. All right, welcome back, guys. So, first thing I'd like to actually discuss is summarizing what happened the past week. Same thing with the last video. I'll post some screenshots here so you guys can get an idea of the timestamps. Now, again, if you haven't watched my previous video, I highly recommend you do. It is immense value, and you get an idea of how I typically like to analyze things and how I don't stray from my analysis until something is validated. Again, if you find value in my channel, please like, subscribe, share my videos, and also the side of me here, there's a QR code in which you can scan and find all the other links and information about Xenith trading. Taking a look at SPX, I had started to provide a thesis that the market was going to pull back pretty heavily in the beginning of December. Again, you can watch last week's video to kind of get an idea of how I came to this thesis. But the pivotal thing about this is that my analysis is valid as long as we continue to hold below the DIC, the daily insight candle that we found right in the first week of December. Throughout the entire time that we were trading within this range, we never closed above. Even though NQ and QQQs were hitting new all-time highs, this was a huge red flag to me. Now, coming to FOMC day, I'm actually just going to mark some of the levels that I focused on this week. 59.6609, and then 59.5018. These are major levels that I focused on. Going into this week, the biggest thing that was going to happen this week was FOMC on Wednesday. And as I mentioned throughout the beginning of December, the implied volatility, the IV on options, specifically for puts, were trading so low in the 10 to 12% range all the way for the week of FOMC. Again, this typically means that the market is getting complacent. You rarely ever see IV that low on SPX. And when you do, you start to look for opportunities on the put side because these types of smaller incremental moves can provide you very lucrative opportunities on option trades. Now, when we're looking at SPX on FOMC, normally with FOMC, as you guys may know, the move doesn't happen until Powell gets on at 2:30. Normally, the 2 p.m. release provides you some volatility and some range-bound action until he gets on, and when he hits that pedestal, that's when the movements come. I provided you guys with an FOMC plan around 8:30 a.m. for things to observe. Number one was to pay attention to the projections of the rate cuts for next year. It was already priced in that we're getting a cut today. No matter what, that's not going to change. There was no surprise that we should expect in regards to no cuts or pause for this release. However, one thing to pay attention to is next year's projections. And I told you guys to watch names such as TNX and gold. Now, you may remember last week, I had provided you gold as a watch list for puts around this area here. We didn't take that yet, and it ended up bouncing throughout the week. And if you actually take a look at gold from a daily perspective, none of these prints throughout the recent rallies that it's seen are bullish. Yes, the trend is bullish, but from a volume price analysis standpoint, this is not something that would be sustained. And again, you're seeing the same thing last week. So we had taken gold puts, I think around here. I'll post a screenshot up here. We took gold puts with the intent of swinging this through FOMC. We had already established that gold was bearish. And the moment it broke back within this range, plus this overall bear flag, already sets the tone that this is going to continue in that direction. Right? What do I normally say? If structure reclaims, it is likely to blah, blah, blah. Not only that, we have two rejections right off the fibs on both times. So this gave us our thesis on gold. Now, you're going to see in just a second on how this kind of builds into FOMC. I had also asked you to watch for TNX. Well, TNX is kind of obvious, right? With TNX, I had initially put this on your watch list back in November in regards to this macro bull flag breakout that was being attempted. Since then, we actually got a bullish retest right down here, right off the MAs, in which the entire trend is acting as an SNR flip. And then this is right before FOMC. So I want you to pay attention to gold and how we traded that, and also TNX. One thing to note that I was starting to spot here was that both TNX and gold were already starting to front run the move expected from FOMC. A breakout in TNX plus a breakdown in gold signifies risk off. The fact that they were already starting to front run the move, and what I mean by that is gold was already retracing back to its previous range, which is already bearish, plus TNX was retesting the breakout once again off a bullish retest. So these two names were already front running the move up on FOMC. Now, going back to what I mentioned in regards to the 2 p.m. move, we initially took puts before 2 p.m. and then we took a SPY strangle right before the 2 p.m. release with a 605 puts, 606 calls. I did not expect the move to happen right at 2 p.m. However, I had emphasized the entire week that 60-35-52 on SPX is going to be pivotal and is your weekly downside pivot. Note how we bounced right off of this on Tuesday. The moment that broke, I immediately gave you guys 6,000 puts. I told you guys say goodbye to 60-35-52 because once that breaks, we're immediately seeing sub 6,000. And then after that, I also took 5980 puts and 5970 puts all the way down. And then we took, I think, 5850 puts. And this entire move happened right on FOMC. And it's not really a surprise. Again, when I talk about price action, I always emphasize the fact that headlines don't matter. The price and the chart will always tell you the imminent move that's going to happen before a headline hits. Headlines only fuel the move further. So this entire thesis that was being built over the course of the past month, I had discussed so many times about how the entire staircasing up on SPX has been on extremely low volume. We were seeing that from pretty much all the way through Thanksgiving. I even mentioned how NQ rallied on Thanksgiving or the day after, even though the selling in pre-market or overnight was extremely controlled. But the rally that came once the cash session opened, it was pretty artificial. It was super low volume, holiday run. So that kind of stuck in my subconscious the entire time that we were headed towards another new all-time high. Looking at this from a sentiment perspective, my entire feed on X was caught by surprise. Literally, no one expected this type of move to happen. No one expected downside. Everyone was bulled up. And even the next day, the close of FOMC day, every single person I saw on my feed was expecting a V-shaped bounce. What people don't understand is that the selling that we saw on FOMC was extremely sustained and momentous. Not only was it high volume, but if you actually watch normal FOMC price action down to the 1 minute, the 3 minute, 5 minute, this is what you would normally see. So let's say this is a 2 p.m. release, you would see something like this, right? And then they may chop it until 2:30. Once 2:30 comes, then typically, depending on what JPal says, he may say something that appears hawkish, but his tone is actually pretty dovish. Then we send, or the other flip side is that, we do the same thing, and then you get a one-directional move later, right? And at the end of the day, it kind of reverses. However, I was watching this 2 p.m. release and the price action. Nothing about this sell-off was telling me that this was going to bounce back. Nothing. From the moment we got that 2 p.m. release and we didn't actually retrace the entire downside pullback here and do this, that's when I knew. So as soon as 60-35 broke, I immediately took puts. This is a very different sell-off than we've had most of the time this year, honestly. It was a very different sell-off. Obviously instilled fear into the markets. So you can't expect a V-shape to happen the day after. So we did structure out, and then we pulled back into the close relatively bearish. I have a 59.1837 level, which I'll add here, which I gave you guys as the daily downside pivot for Thursday. We rejected that. We broke that right after the open, rejected it again, closed into new lows. And then we continued lower overnight. Now let's dabble into NQ. On NQ, I had provided you guys specific levels to watch for throughout the week. What I want you to pay attention to is Thursday overnight, we had traded this and shorted this. And some of you guys took longs based on the targets that I provided. When we were trading somewhere around here, around the open, 43575, you guys know, is a pivotal level that we use intraday. We finally broke that. Once we broke that, I told you guys to target and watch for 320. Here's your 320 level. Here's your 435.75. Here's your 320. Once we broke that overnight, I gave you guys two targets to watch out for. 267.75 and 227.25. And this was also posted on X as well. So I hope some people were able to capitalize on this move. The break of this level provides you another 100 points down. And this is all overnight action into 9 p.m. Eastern. After I sent those targets for you guys, I had mentioned I would love to see a retest of 21.05.150, which is this level down here. Now, why this specific level? Well, if you guys remember what I shared with you in the beginning of December when I first wrote, something feels like it's going to break. This was the same level that I was watching on NQ throughout the entire Thanksgiving holiday, that we continued to reject multiple times before they finally broke through it. What ended up happening is that by the morning, around 7:30ish, we got the retest of 21.051, and that marked the bottom. Around 8 a.m. in pre-market, I had mentioned to you that as long as SPX holds 58.34.17 and 58.05.50, this is where you want to buy the dip. And I also mentioned when the bulls stop coping on my feed, that'll help confirm. So here's your open on Friday morning, right at 58.34.17. The low was 58.32.30. And from then, we popped over 140 points, almost 150 points from that level. Now, Friday was Opex. To see a squeeze like this makes sense. It's not really a surprise, just due to the fact that we've dumped this hard on FOMC and we continued lower. It's Opex. There were, I don't know how many billions or trillions of dollars that were going to expire out of the money because of this. Those hedges will have to unwind and cover. When you take a look at this move, it makes sense. Now, looking forward, can we expect higher? We can, but I would need to see these two levels, 59.66, 59.50, to break and hold in order to revisit 60.35 again. I gave you guys a warning on VIX when we were trading under 16, right around this area here. And I had mentioned to you that this is an extremely bullish setup. And this is your Adam and Eve, correct? This is the same type of structure that I saw on SPX inverted back in October before we got that massive dump intraday. Being short on equities under 16 VIX is not a smart move. Now that we are trading above it, I do want to see what happens here. We got some hard rejections off of my higher levels here, but above 16, it's pretty much semi-risk off for me. And again, you were seeing that in the moves in TNX and gold, even BTC pullbacks, etc. Going back to that Thursday, Friday, I literally provided you guys the bottom tick on both SPX and NQ. NQ rallied 700 points off that 21.051, and SPX rallied over 140 points off the 58.34.17. And this is how we conclude our week. We went out the year with a bang. A lot of people got caught by surprise. I even said in my last video that the Grinch is coming. I hope the timeliness of adding that video was perfect for those who were utilizing the information provided and trading the week based on that. Now, I do want to get into my macro thesis of what I expect and what I've been marinating in regarding SPX for the next decade. I have been playing around in this thesis of a decade-long range on SPX that can probably occur starting within the next 5 to 7 years of our lifetime. I'm going to go over how I came up with this thesis, but I do want to discuss this from a very macro point of view. So here we have SPX on a macro time frame. I'm looking at the weekly chart. There's been a thought that I've been marinating in for the past couple of years, and it's kind of provided more conviction and confluence the more I look at this year. You guys know I've discussed this already with you guys, but I wanted to record a YouTube video so I can upload it. There's a lot of recency bias when people look at markets, and this is very common when it comes to looking at trends and macro analysis as well. Most of the people and the general public and the masses believe that we are still in the bull market of either COVID or the bull market that started at the end of 2022. I've been looking into SPX more. I've been playing devil's advocate. When you take a look at this chart, and again, right now, this is not a log chart, but I'm going to show you guys log in a second, which is typically better used for more parabolic runs since it's based on the percentage rather than the dollar value. When you take a look at SPX from a longer time frame, and you can see this parabola that I drew out here, I've been marinating in the thesis that we are actually still in the bull run that started from the Obama period. Down here. Right after the GFC. Rather than the bull market that started from COVID or the bull market that started from the 2022 pullback. I want to let that marinate for a second. I'm going to show you data points and references that I've looked into to provide you guys with that thesis. And the whole thing about this is that I expect within our lifetime, probably within the next 5 to 7 years, is that we are going to have a decade-long range where SPX can trade a 50% range for a number of years, in which we don't really see new all-time highs. We obviously don't see new all-time lows, but we're also not breaking any major prior supports on a macro level. I'm going to show you guys the rough sketch of what I expect. But let's take a look at SPX from a log perspective. Now, when we take a look at SPX from a log perspective, you see I have a couple of trend lines that I have drawn up here. I'm going to remove this. We actually just rejected this top trend line here to a T recently. This is the second point that I drew it from. So this is about a 24-year trend until it tested this upper trend line. And again, if you look back at the bottom trend line here, it's provided similar resistance turn supports over the decades. And then even with the GFC, we saw a sweep right below it before it reclaimed and sent it higher. I want to pay attention to this MA that I have here. We have not had a sustained bear market trading under this MA since the GFC crisis. If you guys actually read into my 2022 market analysis, in which I did a fractal analysis projecting the entire bear market for 2022, and actually look back at my 2020 market analysis, in which I also used fractal analysis to predict the new all-time highs coming and nailed it down to price and time, and also take a look at 2024, I reference a lot of these previous decades in which I use as data. Now, when you're taking a look at a bull cycle from a macro perspective, and again, I like to reference BTC a lot because this happens pretty often in BTC. What if COVID wasn't a bear market per se, but instead it was a washout and a liquidation candle required in order for the market to see higher and continue this bull run that started from Obama? Just something to think about. And this has been the thesis behind this analysis as well. 2022. If you take a look at 2022 from a higher time frame, it doesn't look like a bear market. That's the reality of this, right? In reality, we just bull flagged our way out of it. And this was a much needed reset from these highs. The reason why I have all these dates and percentages drawn up here, I was going back and extrapolating the data based on how far we deviated off this MA before we started seeing a full reset. I've drawn up different areas where the peaks occurred, leading into retests of this MA, okay? And from 2015, for example, the market saw 20% deviation from the MA, or we started trending back. In 2018, we saw about 24% deviation from the MA before we started pulling back. And again, this is the Trump tariff trade. And then in 2020, for COVID, we saw about a 26% deviation from the MA before we started pulling back into it. And then 2022, we saw a 36% deviation before we started pulling back. Okay, I marked it from the peak in which it started the run or the pullback, I should say. And this is the data that I've extrapolated so far. So on average, you're looking at about mid-20s, a little higher than mid-20s for the distance between the MA and the high before it starts pulling back. We are now trading at 32%. So you take this into account that we're trading within the average of the peak and the MA. Plus, on a log scale, you have this macro trend line that I have drawn that is from 20 years ago. This kind of provides you with more confluence on a larger time frame that we can likely see further pullbacks. And again, doesn't necessarily mean that this happens within 6 months. I'm not expecting that. However, this can be a more sustained bear market that can happen probably within the next couple of years. Now, the other thing is, going back to what I've discussed with the MAs, if you actually look at SPX, this is the weekly time frame throughout its history. The dot-com bubble was a sustained bear market below the trend MAs. The GFC crisis was a sustained bear market under the trend MA. The 60s, credit crunch, all of that. I refer to this period in my 2024 market analysis. Same thing here, 69. Same thing in the 70s. I don't really consider these too much of a bear market. Well, actually, probably minor bear market, similar to something like 2022. But we haven't had one of these. I believe there's more here. Yep. And of course, this is like right in the Great Depression era. Okay. Right in the Great Depression era. I don't want you to mistake me for being a doomsday caller like most of these other accounts are on X. This is just presenting you the data that I found and the thesis I'm building based off this data. So going back to what I mentioned in regards to the current bull market, I don't believe that we're in a bull market right now that started from 2020, that started from COVID. I believe we're still in the same bull market that started from the Obama era. We have not had a sustained bull market yet. And of course, without the log chart, you can see the parabola that I drew. Price has only gotten steeper over time. We're now about close to 20 years of this bull run. And when you take a look at what I just discussed in regards to sustained bear markets, we still haven't had that. Going back to my thesis about COVID, if you've ever actually traded BTC for some time, and if you've been in the market for a while, you're familiar with the liquidation candles that we see. It's like a 5% candle within 2 hours. This is to completely wash out people who are over leveraged in longs and liquidate them. This is the liquidation candle. So on a macro perspective, if you take a look at COVID, what if the COVID run was actually just a liquidation candle on a macro scale of a bull run required in order for us to see higher? Because everyone was over leveraged in 2019. This is not a bear market per se. It definitely was a bear market on a lower time frame. But consider the move that we saw, the velocity of the move, and the trajectory of the bounce. This bear market lasted 1 month from the S&P perspective. And then we saw new all-time highs just 5 months later, even if you take a look at prior data sets that I provided. Now, this type of liquidation candle we see often. It stops everyone out. It hunts all the liquidity. No one is in their positions anymore. Bang, now we can send it. Once you start to compare that and understand how those types of candle prints happen and why the price action happens there, there's a very good reason for that. Everyone that's over leveraged, they have no position in the market now. You can send higher. Leaves everyone behind. And this is exactly what COVID did. Because no one during COVID was buying that dip. Everyone was scared. Everyone thought the world was going to end. Not just from a market perspective, but from the outside world. We projected this entire 2022 bear market in January of 2022, providing you with a specific target of 3,500 to 3,600 on SPX. And we saw the low at 34.91 in October. This was all given to you in early 2022. But the reality is, again, if you look at this from a macro time frame, look, this is really just bull flagging out, right? It's as simple as that. And again, if we focus back on the MA, we never really broken held below this at all. This one lasted a few weeks, okay? So the last time we really had a sustained bear market was actually the GFC and dot-com bubble. Now, this goes into my thesis about a decade-long range in which is the max pain of the market, what I would consider the max pain. Especially with trading so popularized now and a lot more retail traders, they've never really experienced anything like this. I mean, look, let's be real. I was too young to really experience this. Was I investing? Yes, but I never looked this deeply into the markets when I first started. What if throughout the next decade and starting within the next few years, we do something similar to what we had been 2 or 3 times throughout the history of the market, in which we end up with a bear market that can occur within the next couple of years. And based on data that I've shared, markets typically bottom within 2 years of elections. Seasonality this year has not occurred as we would expect at all. Like I mentioned in my previous video, sell in May, go away. We popped in May. July is typically the most bullish month on tech. We dumped hard. September, seasonally, is the worst month of the year. We were bullish. And now we have Santa rally. I told you guys, I think the Grinch is coming. I'm still sticking by that, although I am done trading for the year. Based on seasonality for this year, Santa rally is probably not happening. We take a look at that data. We take a look at the historical data in terms of seasonality. Now, we also take a look at the yield curve inversion. As you guys know, I've discussed this with you previously, and I had mentioned that it's not so much about the inversion that occurs. It's actually the disinversion that leads to a bearish outlook on the market and recession. Again, someone argued that this is not a great indicator of recessions, but the reality is that based on the data, historical data of using the yield curve inversion, this has led to recessions. It is a signal of recessions. And the shaded areas that I've put here represent the recessions that occurred. The inversion itself is not what sets off a bearish market, right? The reality is that it's the disinversion that leads to that moment based on the data provided. So we finally hit that disinversion area back in September or end of August. And now we're continuing to go with that trend. So this is another data point that I wanted to discuss. Now, going back to SPX. Again, what if we are near a top right now, if we haven't already topped out, and we are going to start heading into this decade-long range in which we trade at about a 50% range over the next decade before we start seeing the next generational bull market that looks something like this. Just what if? What if? Again, this is all a thesis. It's all hypothetical, but it's based on the data that I've extrapolated throughout the history of SPX. It's the same thing that occurred here from the dot-com bubble. It's the same thing that occurred back here in the 60s and 70s. It's a decade-long range, right? Before we start seeing new generational wealth and a new generational bull cycle. So what if we are near that point right now? And again, this bull market, going back to what I mentioned, this bull market did not start during COVID. This bull market did not start during 2022. This bull market started during the Obama run. And we are still in that same bull market. To reiterate, my thesis is that COVID was not a bear market per se from a macro time frame. This was a washout. This was a liquidation candle for all the over leveraged longs in the market. This was required in order for the market to see new highs. And if we actually take a look back at the history of these decades, for example, I'm going to take the range of this. Let's take a price range. This range is roughly about a 50% pullback from the highs, correct? Take a look back at the 60s. About 24%, 37%. And then you have this one, which is about 50%. I mean, this is a large megaphone pattern, so it's not exactly the same type of range that I just showed you there, but you get the idea, right? From the highs to the lows, it's 50% roughly. So what if we are nearing the time that we actually do something very similar? And from then, from the breakout of this here, I'm just going to take the low of this. I'm going to extend it to the peak of the dot-com bubble, roughly. I already have this here, sorry. This is about 1,300 days, 2,400% from the bottom of the Obama period into now. 823 days, 800%. We're very far off from the percentage-wise, but in terms of the time period, we're really not that far off. Just something to think about. And this doesn't necessarily mean that we should expect. I'm going to just draw the same exact thing and extend it. 2,400%, 1,300 days, roughly. Yeah, I mean, this will put us at about 16,000 on SPX by 33. I don't really see that happening right now. And again, this is just using rough estimate of what we did back then. But again, the trajectory of the move, I have different points of data in which we can probably see a short-term top at least. And again, I'm not a doomsday caller. I'm not saying that SPX is going to go 2K or whatever it is. But this would actually be the max pain trade that I foresee on SPX. A lot of doomsday callers on X like to keep calling for this crash cycle to play out, your typical crash cycle, right? And everyone is calling for sub 2K, sub 1K, 100. I've seen some insane calls on targets for SPX. I don't actually think that's going to happen. However, do I think a retest of the 3K range is possible? I definitely do. And it would still be healthy on a macro time frame. So what if this is the max pain trade that we can see over the next decade and much needed from the bull market that started during the Obama period in order for us to see the next generational bull cycle? Just something to think about. And one thing I didn't mention is that before I even get into this and before you even think about this, if I shared a screenshot of this chart with you, I didn't tell you the time frame, I didn't tell you the asset, what would your analysis of this be? Yes, the market is built to appreciate over time regardless, okay? Same thing with real estate. Real estate is always going to appreciate over time. However, every market has cyclical aspects. Doesn't matter the asset that you trade, doesn't matter the market that you trade. So when I look at a chart like this, I can definitely expect a top to be put in soon. And on a macro scale, something like this to structure out over the next decade before we run again and continue the same cycle over and over again. Something to think about, guys. Okay? There's a reason why I named this video Tales of Euphoria Max Pain for a couple of reasons. One is because people literally saw max pain this week throughout FOMC, even on Thursday and Friday. Number two, whatever happens within the next decade, I do think it's going to provide the max pain for investors trading in a range like this. I think I've covered everything I wanted to today. It is early morning, so my brain wasn't exactly 100% awake yet, but I do hope that this brings a new idea to the table in terms of how you look at the markets. I'll try to keep updated with this hypothesis. Maybe it works out, maybe it doesn't, but it's definitely something that I've gathered data on, and I've shown you guys all the data that I've provided and found on this so far. Starting from a simple perspective of looking at the log chart, seeing us reject the top of the trend line right here recently, even on a non-log chart or linear chart, there are many different ways you can extrapolate the data from this. The parabolic runs, focusing on the MA that I just provided here, in which we haven't had a real sustained bear market trading under it for quite some time. 2022 was a more sustained bear market than COVID was. This is the washout. This is where everyone gets liquidated, everyone is sidelined now, and no one is catching this movement until much later. With 2022, it was more sustained, correct? If you look at 2022 from a lower time frame, yeah, it looks terrible. It looks terrible. This is hands down a bear market. But again, if we zoom out into a macro time frame, and in this case, we're looking at the weekly, in reality, this is just a bull flag, a yearly bull flag that was playing out, in which we then broke out of and saw new all-time highs. And now we've been trading over 50% higher from these lows. So again, if you find value in my videos, please like, subscribe, share. Think about what I've discussed so far today. I have provided you guys some pretty concrete data and analysis on what I see personally. It'll be interesting to see whether or not this actually plays out over the next decade within our lifetime. And I'll try to keep you guys updated in regard to this thesis. But if you guys have any questions, you guys know where to find me. Feel free to reach out to me. And I'll see you guys next time. Thanks for joining in.